Hello, good afternoon, everyone. I'm Kyle Hill, one of the partners here at Diversified, and I'd like to welcome you to the next installment of our Wealth Webinar series, The Building Blocks of Our Investment Philosophy. In just a moment, I'll welcome our speaker, Michael Horwath, our Chief Investment Officer here at Diversified. Per usual, we'll look to keep this at about 30 minutes so we can get you back to your day. And to make this as efficient as possible, if you have any questions, please type them in, and we'll address them at the end if there's time. Of course, if your questions are not answered today, please reach out to us and we'll be happy to answer them for you.
Perfect. Thank you, Kyle. Welcome, everybody. Once again, I'm Mike Horwath. I am the Chief Investment Officer here at Diversified. I appreciate everybody taking a few minutes out of their day to get together with us again on one of our webinar series. Today, we wanted to switch it up and discuss a little bit about our investment philosophy and really the building blocks to what we do and why we do it from an investment standpoint, from a strategy standpoint. So, looking at the agenda, really wanted to touch on the investment philosophy in general to start, and then go into behavioral finance, what it is, why we like it, and why it, or I guess really how we use it in investment management. And then dive into what we believe versus what we don't believe. I think this is a good forum to really put that out there, what we do believe and really what we don't believe. And then go into more of the investment management, and when we look at building portfolios, how do we come to the asset allocation decisions? How do we look at that? Why do we look at stocks and bonds together? How do we implement, and then kind of tying to the implementation, the manager selection process briefly, and then lastly, what it means to monitor what we're doing. So this is the diversified investment philosophy. We call this really the 5 pillars of our investment philosophy. So first is goals-based investing. This is a newer idea, a newer style of management. The concept is, I think the way in which it's sold to the masses is newer. I think in concept it's been around a while, but the idea is we need a way to match our investment portfolios to our financial plan, right? Everything starts with a financial plan, the financial planning process, and we all have many goals. Some of them can be short-term, some of them can be long-term, some of them are more important than others. Some of our objectives are kind of wishful. Some of our objectives are kind of have-tos. We need to do that. So what goals-based investing says is it's a way to measure the success of your investment portfolios and measure how you're doing in relation to how it's helping meet your financial plan and your goals. So, for example, if somebody has a goal of in 2 years they want to take a sum of money and buy a beach house that they've been saving their entire lives for, that bucket of money should be measured, invested, and monitored differently than a 30-year-old investor who's trying to accumulate money for retirement, right? And they need to be measured differently, and they need to be looked at differently. So that's really all goals-based investing says is looking at your financial plan and your goals and your objectives and making sure your investment portfolio matches those and measuring how you're doing in relation to that. Second, diversification, right? We believe in it so much that it's in our name. Diversification isn't the idea that you are being pigeonholed into a certain risk tolerance or anything like that. What diversification means is that we need to spread the assets around no matter our risk tolerance because it's an efficient way to manage risk, right? So if you're an aggressive investor, you can be 100% equity. What you shouldn't be is invested in a single stock. You should be diversified amongst styles of equity, so U.S., international, small cap, and large cap. You should be diversified within U.S. large cap to the multiple sectors of the U.S. economy. So in the end, it's a way of spreading your risk around. And in the end, what you end up doing is you do not sacrifice return, but you're able to help minimize the risk for that given return. We just look at that as an efficient portfolio. Being tax savvy, being number 3, if you think about it as an investor from an IRA standpoint, we all have IRAs, and if you buy, you sell, you get dividends coming in, you get interest in that IRA account, whether it's a traditional or a Roth IRA, you do not get any tax ramifications unless you pull money out of the account. You can buy and sell all day, and you will not pay tax on any gains that you realize until you withdraw the money. However, think about your bank account. If you generate $100 of interest in calendar year 2019 in your TD Bank account, you can be rest assured that TD Bank is going to send you a 1099 in the spring saying that you owe taxes on that $100. Your non-IRA portfolios act the same way, right? So if you have an individual account or a joint account with your spouse, or if you have a trust account, those types of accounts are subject to taxes every year. And those taxes depend upon the activity within the account. So, for example, capital gains. If you buy something at $5 and you sell it at $10 during the year, that $5 gain that you have just realized is now taxable. If you get interest from corporate bonds, for example, that interest is taxable. Same thing with dividends. So what being tax savvy means is that we need to invest these portfolios differently in an effort really to minimize the taxes, right? It's not what your return is, it's ultimately what you get to keep from that return. And if you're paying a lot of taxes, it's eating away at your ultimate long-term return. So ways in which you can do that are to be lower turnover, right? If you don't sell that security, that fund at $10, you don't realize anything. You can push that gain off. So being lower turnover, so trading less. Changing from the types of interest you receive. So right, if you're receiving interest from corporate bonds, which is taxable, you can flip over to municipal bonds, which are bonds issued by the state of Pennsylvania or counties within Pennsylvania or Delaware. The interest from municipal bonds is by and large federally tax-free. It's just a more efficient way to invest taxable investment accounts. Number 4, risk and reward, right? Risk tolerance, I think, gets overlooked a lot with investing. Risk tolerance isn't just answering 5 questions and calling it a day. We look at it from 2 different angles, right? We look at it from a quantitative and a qualitative angle. And I think the better way to describe that is we look at it from an ability to take risk and your willingness to take risk. Your ability to take risk ties back to the financial plan. When we know everything about your financial situation, your age, your liquidity requirements, we can understand the ability of your portfolio to take risk, right? If your time horizon is 1 year, it's a very low ability to take risk versus a high ability to take risk for a long time horizon, or you have plenty of assets so you're not going to outlive your assets. So I think that's important to distinguish the ability from the willingness, which is us understanding you, right, from a qualitative standpoint as an investor. We can do this through the financial planning process of checkups of conversations, of understanding your comfort level with investing, your experience with investing. We can use risk assessments to help us as well. But we need to find some common ground between the ability and the willingness to take risk, because in the end, if they don't match, we need to make sure we have that conversation and ensure that we're investing appropriately after that conversation. And then lastly, constant monitoring. This is not a set it and forget it type of industry, right? We cannot put you in a portfolio and never touch it again. We cannot create a financial plan and never touch it again, right? Investors all the time, they decide they want to retire early. They decide they want to change jobs. They get a promotion. They have children. All of these things affect your financial plan, and in many instances, they change the way in which we're going to invest your dollars. They can change the ability to take risk. Also, from my standpoint, it is my responsibility and the responsibility of the investment committee here at Diversified to ensure that we are constantly monitoring the way in which we're investing portfolios and identifying areas that we can take advantage of, or maybe areas that we can be more efficient. but constantly monitoring from a financial planning standpoint and an investment standpoint are both very important. So behavioral finance. What is behavioral finance? It's I think the best way to do it is to give an example. A company, Dalbar, every year does a study to see what the average investor returns versus the general market. And what it finds over and over and over again is that the average investor underperforms the market. The reason is just bad behavior. Investors just can't get out of their own way because there's just so much emotion involved with investing. To really be a good investor, you need to emotionally detach yourself from investing. So as much as we are financial planners and portfolio managers for our clients, we are just as much behavioral coaches to ensure that we're keeping you aligned and not letting you get in your own way. So when we build our portfolios, diversification is important and it helps smooth the ride from a risk standpoint. But we internally are very cognizant of behavioral biases that our investors have, and we want to ensure that they don't get in their own way and make wrong decisions from an emotional standpoint. So what do we believe and not believe? You heard the first two, right? Goals-based investing, we firmly believe you should have an objective and a purpose to your investing. Diversification, it's reducing risk through spreading around your assets to multiple different asset classes and asset styles. Dynamic asset allocation is not timing the market, right? Dynamic asset allocation, the way we look at it is making adjustments to your portfolio and tilting your portfolio to take advantage of areas of inefficiencies or areas that we see as opportunities, right? So an example would be maybe we overweight U.S. relative to international stocks, or maybe we go heavier to U.S. treasuries versus corporate bonds. Different economic conditions and different investment solutions that we can access can all dictate changes and things that we can do within a portfolio to tilt to areas that we feel are more efficient or better opportunities moving forward. Active and passive investment implementation. So what that refers to is today there's two different really main styles of types of investing, if you will. It's active and passive. So let's take U.S. large cap stocks, for example. A passive implementation is the S&P 500 index, right? It's the 500 largest U.S. companies, and they're weighted within that index by their size. Very, very simple. Has some flaws to it, but it's a very easy way to access the U.S. large cap world, if you will. So a passive investment style would be to say, we're going to buy something that just tries to replicate that index. Because you can't invest directly in that index, but you can invest in funds or ETFs. You could even do it with individual stocks if you were, bold enough to try that. But the most logical way is through funds and ETFs to access the S&P 500, and it just tries to replicate that. It doesn't make any discretionary decisions. On the other side, you have active investment management, where an active manager is making discretionary decisions to say, you know what, we're going to own 50 stocks, not 500, and these are our best thinking, and we think these 50 stocks that will adjust over time will outperform the other. There's always a debate between which one is better, which one is more appropriate. We think both are. And we think both are because there are certain investment styles that just lend themselves better to active, and there are other investment styles that lend themselves better to passive. So we like pairing both. We like using one or the other in certain areas, depending on which we feel is a more efficient asset class. Right? We just feel active investment management, for example, performs better in fixed income, right, in U.S. bonds. On the flip side, U.S. large cap is a little bit more efficient, right? There's a lot of information. It's a big space that there's a lot of people. So we use some of our passive investment management within U.S. large cap. We believe in both, and we believe in using both kind of in a strategic way. And then lastly, you heard it already, we believe in tax-aware investing. What don't we believe? So we don't believe that a singular index and beating that singular index is an appropriate objective. Far too commonly we hear, I didn't beat the S&P 500. Well, that's just not something we believe is a right benchmark. Think about 2008. That benchmark has no bearing on your financial plan. It doesn't know your risk tolerance. It doesn't know what you're trying to do. And you can replace that index with any other index. In the end, in 2008, if the S&P 500 is down 37% and I get you down 35%, nobody's patting me on the back. The S&P 500 is appropriate benchmark for your large cap stocks, but not for your portfolio. It is not an objective to beat that singular index. So that's why goals-based investing is so important, because it can tie to your financial plan. It can tie to your risk tolerance. We don't believe in timing the market. Right? This is the other end of this dynamic asset allocation or even strategic asset allocation, where you make smaller changes. Timing the market is saying, I'm going to get in the market at its very low, and I'm going to get out at its very high, and I'm going to keep timing that so I can avoid any downside and get all the upside. Here's the challenge, is that nobody can do it consistently. There are too many decisions that need to be made, and there's too much emotional bias that can get in its own way for that to work. We have yet to find anybody or any manager, professionally or not professional, that has been able to do it consistently. And being out of the market during times of run-up ends up causing more harm to your portfolio than getting out at the right time. Right? There are studies that show that the best days in the market, right, some of the best days in the market happen within days of the worst days. So it is very hard for investors to get out before those worst days and then get right back in. So it's just something we don't believe and we don't attempt to do. We don't believe in buying high and selling low. So buying high, selling low, that's really chasing returns, right? That's chasing something that's ridden up high and then buying it, or something that's fallen and then selling it at the wrong time. We believe, you should be buying low and selling high. You should be rebalancing your portfolio, which is a big help towards doing that. And we don't believe in trying to time things at their high and ultimately chasing that. And then lastly, we don't believe in concentrated portfolios. Many of our investors have worked at their place of employment for 30, 35, sometimes 40 years. The same place, and really their household net worth has been concentrated in that single company for several years. And now that represents potentially 50, 60, 70% of their household net worth. In today's world, there's so much volatility from quarter to quarter, and these companies are so reliant on quarter to quarter earnings that we don't feel it's appropriate to concentrate your portfolio in a single company. Even if you fully believe in it, it should still be diversified. It can be a piece, but you can accomplish your same goals by being diversified and reduce your risk substantially. So kind of following this into our asset allocation and how we design portfolios and how we kind of implement them. When we look at building our portfolios, we kind of look at it from two lenses: equity and fixed income, stocks and bonds. I'll talk in a minute, why stocks and bonds. But, in short, stocks are ownership of a company, right? You own shares of that company. Debt, or fixed income, is just that. It's the debt of a company or a municipality or a sovereign nation. Some sort of entity is issuing debt. So when we look at diversifying portfolios, you go from the high-level asset class level, and then you work your way down. Because within equities, you have U.S. and non-U.S. Within U.S., you have large and small cap. You have multiple sectors within each of those. You have different investment styles. Within the non-U.S. world, you have developed countries, Japan, Germany, France. You have emerging countries like China and India. Within the fixed income side, so the debt side, you have U.S. and non-U.S. Within U.S., you have so many different levels underneath that. You think government treasuries, you have corporate bonds, you have mortgage-backed securities and treasury inflation-protected securities. You have higher yield securities, which is the debt of a lower credit quality company. In the end, you start at the highest level and we start to work our way down. And we have a way that we allocate both of these to make sure we're efficiently spreading around the assets in a way that makes the most sense and spreads the risk around efficiently. So why do we look at equity and fixed income together like that? Why are stocks and bonds kind of the ballast of our portfolio, the highest level? So when you think of it, equities are going to provide the best long-term growth, right? They're going to provide long-term real growth, which means they're going to keep up and help hedge against inflation. And we know stocks have more risk than bonds. Why is that? If a company, say Apple, goes out of business and says, we're going to declare bankruptcy and now we're in liquidation. We're liquidating our company. The debt holders will get paid before the company owners. So bonds will get paid out before stocks essentially will. Because of that, stocks carry more risk and you are compensated over time for that risk. So equities will provide longer term growth above bonds. Why would we own bonds? Right on the right-hand side, I think this top chart and bottom chart give a good example of why. So the top represents the Barclays U.S. Aggregate Bond Index. That's just U.S. bonds in general. The bottom is the S&P 500 Index, so U.S. large cap stocks. These are major crises over the last 20-ish years. I think you would be best to focus here in the center for the tech bubble for the right around the year 2000, and then the subprime crisis that we went through most recently back in 07 through 09. You look at what happened with the S&P 500 during those times, major pullbacks during those periods. And what did bonds do? The U.S. bond market held up very well, if not went positive. That's because there's a flight to safety, right? People view bonds as a safe haven. And when that happens, it is a good hedge against equity market risk. So bonds help us create a risk tolerance and an allocation that can be aligned with your risk level. Obviously, more aggressive investors should be more stock heavy. More conservative investors should have diversified bond portfolios with lower amounts of equities and anywhere in between. The U.S. bond market and the U.S. stock market have never been negative in the same calendar year, which is important to think about. And there's only been 3 negative calendar year returns for the Barclays U.S. Aggregate Bond Index, right, since 1976. That's important because that is going to be the stability piece of your portfolio to provide income and a little bit of growth. The equities are supposed to provide us the longer term growth over time. So now that we've figured out, hey, we want all of these asset classes, we understand why we want stocks and bonds, and we're going to diversify amongst all these different styles. How can we implement? How can we put those ideas into action? Right? And there's different ways you can do so. And we have done and we continue to do multiple different ways. You can use mutual funds. Mutual funds are pooled vehicles that many investors can kind of scale and get into with other investors that a portfolio management team manages on their behalf. You also have exchange traded funds, which are referred to as ETFs. Those trade like a stock, but ultimately they're designed to track an index. So, for example, if you wanted to track the international markets, you could get an international ETF, and it just tracks passively the international markets. And then lastly, you could always implement with individual securities, so individual stocks and bonds, which is the most complicated, the most sophisticated, when you're dealing with that at the individual portfolio level. But it's a way of implementing, and you just want to make sure you're always diversified when you go that route. So, for example, if we decided that we're going to go with mutual funds, how do we choose then the mutual fund that we want? First, we need to identify what we're looking for. So we discussed earlier that we want to diversify amongst U.S. large cap and small cap and international. So say we want a U.S. small cap fund. We need to find what we feel is the best small cap fund. So we have identified the need that we have, and then we need to go through our process, right? This is our process, the way we look at it. We first do a quantitative screen. So what that means is we're really screening out this universe of thousands of mutual funds and trying to narrow it down to a handful, right? So we're going to screen for performance, cost, make sure their style is correct, make sure the management team has been there and together for a long time to show that they've done it together and there's a culture that they all agree with. We look at how they manage. So we look at making sure that they're truly active managers. So all of that screening comes together, and then we can get a handful of managers that have the quantitative qualities that we're looking for. And then it's our job internally to interview each of these options, really in the effort to now get more of the qualitative information, right? To understand the people, the process, and the philosophy behind what they're doing. And in the end, after we do our quantitative and qualitative processes, now we come out with our U.S. small cap fund, for example. And it doesn't just stop. Now we are to hold that fund and that manager accountable for their performance and their management style. And if we feel that there's a better option, or we feel that they haven't been living up to expectations, we have the ability to switch them out by doing this process all over again. And you can do this same process even with passive management, right? There are plenty of passive large cap indexes, for example. You can go through this same process. It'll be less data, but it will still help you figure out the types of company or type of implementation you want, which company is the most appropriate from a cost and from how well do they track the index. You can follow this same process to a less extent for passive managers as well. So in the end, we have to also monitor and then restart that process. Why would we make changes? Really, the changes come from two main angles. First, you heard earlier that dynamic asset allocation conversation. So dynamic asset allocation, we may, based on economic conditions, tilt the portfolio one way or the other. That may mean we need to add different types of funds. We may need to sell some of one fund in favor of the other. But we need to tilt your portfolio based on these economic conditions and our beliefs, based on the research that we're doing internally, and really the partners that work with us outside of Diversified. The other option is, just like we discussed a few minutes ago, U.S. large cap or U.S. small cap fund for another U.S. small cap fund. Maybe we found somebody better. Maybe we found somebody at a better cost. Whatever the reason may be, we can switch fund for fund. But those changes happen through monitoring the investment portfolios, and it's handled internally with the Diversified Investment Committee. So from start to finish, we look at your risk tolerance. We're looking at the risk tolerance of our clients and what they need. We try to understand the need that we need within our portfolios and how we want to implement that portfolio. Go through a due diligence process to make sure we're implementing in the correct manner. And then lastly, we're monitoring both the financial plan to make sure that our risk tolerance is aligned and the underlying investments to make sure we're doing it in the most efficient way. So ultimately, this is what we consider our process. So I hope this was helpful. I hope this provided some insight as to our philosophy and the way in which we manage portfolios and the way in which we look at investments. But I do encourage you, if you have any questions, please don't hesitate to reach out to Dave, Andrew, and Kyle. We'll be happy to get you an answer or happy to clarify anything. I'll be back in February, where we'll be going through the the economic update for 2019. Kyle's about to tell you about our next webinar, but I do appreciate everybody taking the time today, and I'll pass it over to Kyle.
All right, thank you, Michael. And just from a housekeeping standpoint, I did want to remind anyone, as Michael already said, please reach out to us with any questions that you have. We're certainly happy to help talk you through those. Also, as a reminder, we are recording this webinar, and we'll have it posted to our website for easy access. Please feel free to share it with anyone that you think may find it of interest. And then lastly, please save the date for our next webinar. We'll be hosting another on December the 11th at noon. Thank you, everyone.